We are staring down a fiercely unpredictable market in 2026. AI is rewriting entire industries, but against a backdrop of deep economic whiplash. The Federal Reserve's shifting policies are adding to the pressure, making traditional growth forecasts incredibly fragile. That's why we need to look at fundamentally strong companies with clear growth drivers. Here is a list of 7 high-conviction ideas that analysts are watching closely for 2026, starting with heavy hitters like NVIDIA and Microsoft. Knowing these ticker symbols is just the first step. To survive, you must understand exactly how each stock functions inside your portfolio, whether it acts as a weapon to drive growth or a shield to protect your capital. The hardest decision you face right now is the tug-of-war between FOMO and fear. You want to capture the massive upside of a secular megatrend, but you absolutely cannot afford a catastrophic wipeout if a sudden correction hits. The most practical way to solve that tension is by looking at what's called a barbell strategy. On one extreme of the barbell, you load up on high-valuation, explosive growth engines. These are the aggressive assets required to actually beat the market and capture massive upside. On the opposite side, you counterbalance that risk with low-volatility, defensive anchors. These are the traditional companies with unshakable economic moats that preserve your capital when the growth side takes a hit. Success depends on finding the specific weight for each side of the barbell that matches your personal tolerance for risk. This chart maps out the risk versus reward matrix for our 7 assets. The top right quadrant holds the aggressive growth engines, companies with high valuations because they control the proprietary hardware and software powering the global AI rollout. NVIDIA remains the undisputed leader here. The demand for their data center GPUs is intense, and they are actively expanding into robotics and autonomous driving. Holding this stock means you get maximum portfolio exposure to the rapid global build-out of AI infrastructure. Broadcom operates as a critical secondary layer. They supply the custom chips, or ASICs, that massive cloud providers desperately need to run their AI systems. But the trade-off for these tech hardware plays is steep. If there is a lag in cyclical hardware demand or a sudden reset in tech valuations, these stocks are exposed to massive, rapid pullbacks. Disruptive growth doesn't only live in Silicon Valley. Eli Lilly shows us how explosive upside works outside the tech sector. Their breakthrough weight loss and diabetes drugs, Mounjaro and Zepbound, tap into a massive healthcare market that remains completely detached from tech's volatility. Yet, the pharmaceutical sector carries its own specific hazards. Your returns are entirely bound to the binary outcomes of clinical trials and the constant threat of regulatory pricing pressure. These growth engines offer the kind of gains that make a portfolio. But loading up entirely on this side of the barbell means you are betting heavily on perfect, uninterrupted macroeconomic conditions. If you want to bridge the gap between volatile growth and rigid stability, you look to the middle ground. These are companies that blend aggressive tech scaling with the safety nets of established global ecosystems. Microsoft presents a formidable dual threat. They dominate cloud computing with Azure, while simultaneously weaving AI directly into Office, GitHub, and critical enterprise software. This highly integrated approach delivers reliable revenue growth alongside uniquely strong profit margins. Amazon fits a similar profile, driven largely by AWS. Their cloud computing arm remains highly profitable and acts as the financial backbone for the entire company. Even when overall growth slows down, Amazon's tightening efficiency and margin expansion in their e-commerce and advertising divisions provide a substantial financial buffer. For your portfolio, these hybrids do something very specific. They let you participate in the secular AI megatrend without subjecting your money to the extreme boom and bust cycles of hardware manufacturing. However, while these hybrids certainly limit your catastrophic downside, they still trade at premium tech valuations. Because of that, you cannot rely on them to act as true defensive shields when the broader market contracts. That brings us to the far left side of the barbell, the traditional low-volatility bedrock companies. These assets are engineered specifically for capital preservation. JP Chase anchors this category as a best-in-class bank with a highly diversified revenue model and a fortress balance sheet. Their defensive strength lies in their environment. Banking actually benefits from the higher interest rates that typically punish high-growth tech stocks, making them incredibly resilient. Alongside them is Visa. They operate a dominant payment network that continuously captures steady, secular growth as the world shifts further into digital transactions. Visa possesses a massive protective moat built on decades of historical legacy, institutional scale, and incredibly high profit margins. Adding these to your portfolio requires a deliberate trade-off. By securing this level of safety, you are actively choosing to sacrifice the hyper-growth multipliers you'd find in the tech sector. But that sacrifice buys you something crucial. These defensive anchors act as shock absorbers, giving you the psychological stability required to hold your ground and prevent panic selling during inevitable market corrections. Moving from individual stock analysis to actual execution means stepping back. Success in 2026 requires building a personalized blueprint that maps these assets to your specific reality. This flowchart maps out 3 distinct pathways to help align your risk tolerance with the right asset mix: the growth optimizer, the defensive strategist, and the balanced barbell. If you have a long time horizon and high risk tolerance, you are a growth optimizer. Your path involves weighting the barbell heavily toward the aggressive buckets of NVIDIA, Broadcom, and Eli Lilly. Just be prepared for the psychological tool. To capture that upside, you must be fully willing to endure 20% drawdowns without capitulating. If your primary goal is capital preservation, you are a defensive strategist. You anchor heavily with JP Chase, Visa, and Microsoft, completely avoiding the pure-play hardware sector. Finally, the balanced barbell profile uses Visa and JP as a protective base, Amazon and Microsoft as steady compounders, and keeps a small, aggressive sleeve open for NVIDIA's upside. Remember, this is an educational breakdown based on current fundamentals. Always do your own thorough due diligence, and grab the free summary sheet linked in the description for a closer look at these metrics. Ultimately, surviving 2026 requires engineering a portfolio that balances these high-conviction assets against your actual psychological capacity for risk.
I hope you liked this video. Don't forget to like and subscribe.